On the line with me today, I'm fortunate to have my guest. His name is Jeffy Fragale. He's a real estate investor and a commercial real estate broker. He's based in Canada, Toronto, Canada, and he's with Avis and Young. Jesse, welcome to the program.
Hey, Darren, how you doing?
I'm good. I appreciate you taking the time to do this today, and I'm looking forward to talking to you. Before we get going, I gave a very, very brief introduction there. I was hoping maybe you could give the listeners a little bit more of your background, and then
Sure.
we'll get into how you got into real estate.
Yeah, absolutely. Well, actually, just by trade, my day job is in commercial real estate. I'm in office leasing in Toronto, and for your listeners down south, it's up in Canada, Ontario. I got into real estate actually. You know, I mentioned I was recently on the Bigger Pockets podcast, and I kind of went through the story, and a lot of it really is the fact that my father was an entrepreneur. His brothers, the three of them, they owned a automotive service. So they owned a garage, not stereotypical at all for Italians, but they were investors in land. So I was always exposed to investment at an early age, and he had a few friends that did rental properties. So when I went to university, I coincidentally lived with a kid I grew up with who we lived in a property that his father purchased, and he was renting out to us. And that's kind of when the light bulb went up, and I started thinking, you know, why don't I just do this on my own if it's possible to break in? So the first one was the hardest one because, I mean, as a kid, I was in school. Probably shouldn't have bought it. If I had a kid now, I'd probably tell him to get a job before he made any moves like that. But I convinced my mother to help me out on the first one. My dad, they're divorced, but my dad took a pass on it and taught me a lesson at that age. And yeah, the first one I bought was a student rental in Waterloo, Ontario, which is about an hour and a half from Toronto. I remember it like it was yesterday. It was, you know, $245,000. It was 5 students that went to the university there, and that was my first investment. And then from there, I started kind of building a small portfolio of student rentals over the years.
Got it. So your first one you said was it a one house with 5 bedrooms, or was it actually 5 separate units?
Yeah, exactly. It was a single family house, technically converted. So you see a lot of these around the university areas. It was an old Victorian house. It was actually a beautiful house. I always joke around with my buddies today that if this thing was in Toronto, you know, it'd fetch a pretty decent price. And yeah, so in Waterloo at the time, they were just in the process of putting a license procedure for lodging houses, as they call them, or student rentals. So I was really getting the learning curve right off the hop, and I had leases in place. I had five female tenants, like I said, and I mean, this is going back a few years, but I think on average it was $450 a student. They were paying $450 all in a month. So I had some I had some lift there.
Wow. And
Yeah.
so I take it that was a successful first property. You had a good experience. Did you go on from there and do more, or what'd you do?
Yeah, so that one, it was, I sold it probably, I want to say 3 years ago. It was great. I probably had 3 iterations of different student groups. They usually stay there about 2-3 years at a time. And then from there, I purchased my second property, which was near so there's 2 universities in Waterloo. The one that I went to was not the one that I initially purchased by. So the second property I bought was in Waterloo. I was able to utilize some of the equity in the first property. And if you guys remember at the time, that's where BlackBerry was trading at about $100 a share, not so much today. And that their headquarters was in Waterloo. So we were seeing a pretty nice uptick in appreciation, which allowed me to buy a second one there. And then I would say over the span, I believe it was 4 years, because I was still in school, that I purchased 4 properties in the Waterloo area. And then finally, after school, I started working in Toronto, and just, you know, that was coincided with my sister going to teachers college on the other side of the city, and I ended up buying a student rental out there. So that was the kind of the A to Z in terms of the single family student rentals. And then beyond that, I started getting into some condo rentals, and then eventually moving into the multi-res side.
Got it. You say condo rentals. Were you buying the condos and renting those?
Well, what was happening near a lot of the universities, and it started in Waterloo, is that developers started building purpose-built student rentals within condos. So they would say a 1+ den, a 500 square foot condo. They would call them luxury, and because they, as students, you'd have the pool tables, you'd have the amenities, and you'd have 2 students that live in the one efficiently built condos. You've seen some of the technology today, what they can do in small spaces, and they started selling those with 2-year rental guarantees. So, for instance, if you purchased one for, say, it's $150,000, they would say that we're going to guarantee you that each month you get $1,000. That's our guarantee as a property management company. We'll also give you 2 years of free property management, so no charge to you. And then in the 3rd year, we start, you automatically have us at property management unless you tell us otherwise. And the reason that was appealing to me was, you can imagine after, I think it was 6-7 years of the repair and maintenance variables on the student side.
Right.
It was nice to get a shell that, was pretty much turnkey.
Got it. So in the time that you were in the single families and in the condos, was quite a bit of appreciation going on in the marketplace, or?
Yeah, the appreciation for the area, it was kind of you hear a lot of times about people talking about being successful in real estate, and you dig deeper to most people's story, and there's usually, there's success, but there's a aspect of luck in any story, and obviously, we try to be in positions to have good luck. And this was when I first started purchasing. It was 07, 08, and that didn't mean as much to Canadian investors as it did to a lot of your markets in the States, but there was still quite a bit of appreciation from 07, 08, right up to today. So I was fortunate that there were some nice increases, and going to the end of the story, the student rental story is that a lot of what I've been able to do today was a result of selling off the student rentals I held, when I was 19, 20.
Got it. And were they all cash flowing all through while you had them?
Yeah, aside from a few months where you would have an income statement issue, whether you're not an income statement issue, if you had, say, a capital expenditure, something big where you have a month or two where you're eating that cost. But I mean, from an income statement perspective, amortized capital expenditures, they were all cash flowing pretty nicely. And what was an added benefit is that when I did start working, or even right before that, the benefit of being a student that just started working, I could almost offset, because I held them in my personal name at that time, I could almost offset all of my income at the first couple years of work outside of school with these rentals.
Wait, when you say your income versus say it one more time, the income versus
So my personal income when I started working, and when you first get involved in real estate, I don't know how much this is on everybody's radar, but realizing that any depreciation losses that you have with your real estate can actually draw down your taxable income on your employment income. I believe you guys call it W-2. We call them, we're in the T system, so it's a little different.
Gotcha.
But I think a lot of people, and I'm really starting to appreciate that more. Not sure if you've listened to, I think it's Tom Wheelwright. He's a tax advisor at Rich Dad Poor Dad, kind of Rob Kiyosaki's circle, and he's been on a number of the major real estate investment podcasts.
Sure. And
he talks a lot about this idea of cash flow positive, but a zero tax liability. And really, depreciation is that key piece. If you're making $50,000, for simplicity's sake, if you're making $50,000 in cash flow, but you have $50,000 in depreciation expense, your effective taxable income is zero, right, but you still have $50,000 in the bank. And I think that's why we're all doing this. We're all right, trying to have that low tax and good cash flow.
Right. No, and that is kind of when you peel back the onion, some of the more of the benefits of real estate as opposed to, like, say, just the cash flow or the appreciation. But when you really get into the taxes and really understand the benefits there, and then even like I'm learning more and more now about, the carry forward of that depreciation if you don't use it, or when you when you go and sell a property, using that to offset your gains as well. So good stuff. So all right, so we are a student at Waterloo. We buy some properties. You do some of the condos, and now you're entering the professional world. So do you liquidate all those before you become a professional, or did you keep some of those, or how did you transition there?
Yeah. So what I ended up doing is I kept a portion of them. I think maybe over that time I sold one of them. But what I realized was that, going from being at school, I was close to the properties. Moving to Toronto was about an hour and a half away from the properties. So there was a logical step to get management, which was good and bad. Now I can appreciate, like you were saying, you're constantly learning in this business. I tell my partner this all the time, is that you really can now appreciate how important good property management is if you're going to outsource it. And even if you're going to do it in-house, it's not necessarily that not everybody's a great property manager and should manage their own properties. I think it's a case-by-case type of decision. But what I did was I ended up working for a couple years and held on to them. And as I was slowly growing in equity appreciation, I started selling off the student single-family houses first. Because those were the ones where I started to look at kind of the schedules of major replacements, whether they're furnaces, roofs, the major items. And I was going, okay, I'm in an area right now where if I sell them right now, I'm not giving somebody the major expense in a month, but I'm getting close to that. So
right. Tick, 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 tick.
Exactly. So that was where I started to look at. That's why when I started buying those student condos, that was one nice thing, was that these things, because they're, you have your maintenance expense, but that's really your CapEx, right? They're really charging you for, all of that. And it was just manageable. And then it was finally, connecting with a gentleman I work in named John, who just coincidentally happened to be in our apartment group at Avis & Young, that we said, hey, you've got leverage, you've bought properties, your credit score is like 1 million because you don't do anything, you pay everything on time. And we started to realize, and it took me a long time to really want to have a partner. And I'm sure you get, people that you speak with, are just, sorry, go ahead.
No. I think there's a natural reluctance to it. It's I don't know if it's selfishness or fear of, somebody. And a lot of it, I think there's probably some healthy fear from partnerships, because you don't have to look too far to find the horror stories of partnerships that have gone wrong. But I think that, it's all, or at least what I've seen, is quality of individuals and kind of a clear understanding of what is going forward, when you enter the agreement and how it's, I think probably, and I'll sum it up this way, I think the best partnerships I've seen, they start with, how are we going to undo this as the premise? And from that point, they work backwards into, let's go forward kind of thing. And I think, again,
that's a great point.
I think it's just, it's in insurance. I mean, there's plenty of life insurance scenarios talking about key man insurance and all these, things. And you find out how relatively few people actually have the stuff, as opposed to actually if you start with an agreement that explains what happens if one of us wants out, and how do we fund the eventual kind of stuff. So, but anyway, so let's talk a little bit about this, because I think that kind of brings us up to the current day. So you've been and how long have you been practicing commercial real estate?
So I started my first property. I remember putting the offer in when I was 19 and turning 20 by the time we got it signed up. And I'm 28 now, so It's been about 8-9 years.
Okay, and how long have you been working as a commercial real estate broker?
So commercial real estate, I've been doing for about 4 years.
Okay.
And prior to that, I was working for oil and gas company, one of our largest companies, Enbridge in Canada. I think they're got a couple locations in the States as well. And kind of my background in finance and economics, I think a lot of the guys that end up going into the commercial world, a lot of them, are some stripe of business or, finance background. And so that was at Avison Young, and that's my exposure to the office side was a nice introduction to a little bit more sophisticated underwriting for real estate, and seeing how the large institutional guys are underwriting and valuing their assets.
Got it. All right, so you start off at the commercial brokerage. You're working in the oil and gas, and you meet your partner now that you've gone on and invested with. Tell us a little bit about your first property and kind of that, some of how you guys came up or found the property and ended up acquiring the property.
Sure. So initially the partnership itself, I think John saw that I was investing, and we talked about this earlier, that you see a relatively small amount, or I've seen a relatively small amount of brokers that actually invest on their own, which is always boggles my mind, because I mean they have they're closest to the pulse of real estate, and they're usually probably in a better position to look at good investments. So John saw, I think, that I was investing in real estate. I think he was itching to get his first property. And for me, the fear of having someone that maybe wasn't as sophisticated or as committed was alleviated from the fact that, he was in the apartment world. He was selling stuff that was multiples of what we would be able to afford, which opened myself and himself up to a network of people that would otherwise not really look for us. So the underwriters that we had, the mortgage, the brokers, the insurance, the valuation guys, when we ended up looking for our first apartment, we had this good team of sophisticated guys that they'd make fun of our property because it'd be like the little house. They'd joke around, but good group of guys helping us out. So what we eventually did was started to look in periphery markets, because I'm not sure if you're too familiar with the Toronto market right now, but cap rates have been suppressed to the point where we're seeing stuff in the high 2s, low 3s. It's just, especially the core assets, it's just very hard to find yield. And there's a number of factors that's the case. So we started looking about an hour and a half outside of the downtown market. And what we came up with was an area that we really liked, and also, most major markets in Canada have a university, but this wasn't student residence. It was a place called Hamilton, Ontario, which probably the best example I could get that most people would understand is it was kind of like a Brooklyn to Manhattan, where it was a bit outside the area, but you did have a lot of people starting to commute in and buying property in Hamilton, and then those residential prices have been starting to appreciate. So we found an 11 unit out there, and I guess just to back up, the first one we saw, this is a great story for anybody that's a little timid with real estate. We found a 13 unit, went in to see the place. It was the sketchiest area I think John or I has ever been in. I think we saw a drug deal happen at the base of the place. Right. Some guy hands something to somebody, so right away we're like, here we go. This is interesting. We met the guy. And we go through the whole building. We start looking at each suite, because that's something that we said we would do on these smaller ones, is make sure you go into each suite once we actually had put an offer in and went to tour. And then we get to the last suite, and he said, "Okay, guys, I got to tell you something." And John looks at me, and I look at John. And I'm like, "Okay, something's up here." So what happened? And this does happen. You own apartments long enough. It's not if, it's when. And there was a gentleman that unfortunately passed away in the suite, the lower level suite.
Oh, wow.
And it happened probably 2 days before we got there. So now, as much as you can say that's something that's, part of, it's a reality, especially in some of these areas, we weren't prepared for that at all. So it was like a hex on the whole building.
Oh, yeah.
And so we're like, okay. And so we still tour the unit, and John and I we're just freaked out at this point. And we're starting to think, is this for us? That being said, we got over that. That deal just didn't end up working with the numbers, but we did keep looking, and we ended up finding this perfect 11 unit just outside of the city, where there was enough lift in the rent that we could add value, but it was stabilized with the boiler, which was brand new, which the roof, we had a deal negotiated where we would have that covered. And then one of the benefits of being agents ourselves is that instead of getting the commission on the deal, we always put a clause into our deals basically saying that the total value and commission will cover the closing costs of the deal up to X number, which would just be that that commission plus taxes, which we found has worked really well. It almost, we normally don't have any costs outside of the down payment of the deal once we do that.
Well, that's sweet. That's it's a good strategy, I would think. You're gonna, if you take it in as income, then you're gonna pay tax on that, right? Or as opposed to lower your
and then the old brokerage gets the split, which hurts just as much as the taxes.
Right.
Yeah. So I figure we put it to money that we would otherwise have out of pocket, because it's one thing, as it's one thing to leverage money, but levered 100,000 is very different than 20,000 in cash.
Right. No, exactly. No, I like the even just the reference there on the roof and the boiler. I mean, that I think so often I talk with people, and especially B and C class properties, more C. I mean, your CapEx, that if you're not aware of and thinking about those things, and putting some sort of number in there, you're going to be surprised when all of a sudden the roof's leaking, or the AC's out, or you got to replace the heating or electrical or something like that. So.
Well, I think it was you you had a podcast with is it the last name's Faircloth?
Yeah, Matt Faircloth. Yeah.
Yeah. So I think it was Matt. I think that one we were listening to, that he basically, the top-down approach when you're going into these apartment buildings of, I don't want to see the nice suite right now. Let me see some of the systems. Let me see the stuff that most agents don't want to show you right off the bat, and let's go from there, because I can find out really quickly that if this is a building for us or not. By seeing those major issues, potential issues.
Yeah, I think it's absolutely, experience, and it sounds like you had the experience in recognizing it was time to sell before those things lingered on and became an expense. Because I think one of the things that I found, and we still have a handful of single-family properties, but, anytime you think you're making cash, you're probably fooling yourself, because when that bill comes and you add up all the numbers and you do the math, you'll find out that actually you're probably breaking even, on single family from month to month, year to year, based on the cash that you're taking in and the improvements or whatever you're going to have to do, whether it be a paint job or roof or heating, cooling, or whatever.
Well, you guys have a site. I don't know if it was you that referenced it in the States, where it goes in the average cost per unit cost of miscellaneous items, whether it's repair and maintenance, marketing, and capital expenditure is always one I find so interesting, because in our world you have the real estate investment trusts, and you have these apartment guys that will put $250 per unit, and it's almost always $850 or $750 or even $1,000. But we kind of actual. And we kind of turn a blind eye on it, because, you have underwriters that will say, well, it's above the line, it's below the line, it's not real money. But at the end of the day, it's an expense, and somebody does have to pay it.
Yeah, and I think, it's there's always a timeline too. I mean, that number can be bigger or smaller depending on how well things are maintained and how imminent the replacement is. But it is something that I've clearly learned over time, and I think anybody that's been in it long enough realizes, okay, wait a minute, I got to plug something in there to be realistic. And then I think, what I learned, I think I was talking with Bo Beery a little while back, and he was talking about, kind of that range. It may actually be 500, but, you may only get away with 300 in the actual deal as far as running your numbers. And that's just part of it. As long as you know that and are prepared for it, I think you're going to be okay. So, all right. So you found your 11 unit before we got the call going here. You and I were talking, and it sounds like you guys have, or actually, before we jump into your next one, everything, the 11 units, you've got that now, and it's up and running, and everything's the way you expected.
Yeah. So the 11 unit, we eventually got in there, stabilized that. We the only work we had to do this one. This boggled my mind, but the owner was an older gentleman. As with a lot of these properties, you have people that are kind of at the end of their investment career, or there's just, they took it on and maybe it was something that was a little too much for them to handle. But it was a really bizarre situation with this house, and we kind of laughed about it after, in that we negotiated at the time that the roof would be completed at our costs. And I believe the quote we got for the roof was somewhere between $15,000 and $20,000. And we were expecting that was going to happen. And about a week or two before closing, we kept getting calls from the agent, the vendor's agent, saying, guys, really should get in there to do the roof. And we said, yeah, no, that's fine, but we're going to wait till we close, obviously. And we kept getting these emails. And what I started to say to my partner, John, I was like, something's going on here. I've got a feeling, I've done this long enough. I got a feeling that roof's leaking. I've got a feeling it's leaking, and that they know that their tenants are probably telling them that we got to get this thing fixed ASAP or there's going to be a major issue. And I said, in addition to that, I have a feeling that they don't think we're going to close on this, and they don't want to be left with quite literally the mess. So anyways, they stopped emailing. We ended up finishing the transaction, and then when we did our first suite turnover, and that was the other major thing that we needed to do, we planned to turn over one suite. We went up on the roof to start taking pictures to get this quote, because our lenders actually required us to do that roof. We get up there, and John's looking at me, and I'm looking at John, and I'm like, I'm not a roofer, but I'm pretty sure this is a new roof. And he's like, no, I'm pretty sure it's a new roof as well. And what ended up happening is they replaced the roof. And we went back to the owner, and we said, well, we don't understand. And they're like, no, we had to get it done. We had to do it. And there was no contractual obligation for us to pay for it. So, me being a little cheeky, sent an email to the agent and said, okay, well, would you mind sending the receipt? Because that was an expenditure we wanted to cover for next year, because, we can go into this, but rent, it's very tough to increase rent in our market. There's rent control issues in Ontario and Canada in general. And he said to us, he goes, you can have the receipt. It'll be $7,500. So I think what basically he was saying was, you either get the free roof or you pay us for this piece of paper. So we ended up just getting the free roof. But I don't think it'll ever happen to us again. It was just a very bizarre situation.
Wow. So just over the time from when you had it under contract to closing, like you said, or like you think, they were having issues, and they went ahead and had it done, as opposed to you having to do it once you closed on it. Is that, and what kind of confirmed that to me was when we had our contractor in there, we were looking at the roof, and we could see a bit of evidence of that. And that was something we just made sure, everything was okay. But yeah, it was just a very, very interesting situation. But that being said, the other major project we had was turning over a suite, which was, we've just finished. I think we finished a couple days ago. So I can get into a little bit. In Canada, one of the major differences is specifically in the Toronto market, and I think you've had people on in New York or Pennsylvania where it's similar to this, where you can only increase rent by a certain percentage every year, and ours is, last time I checked, 1.8%, which is, it's just low. What's the rate of inflation? Are you keeping up with inflation? Or?
Yeah, it's very closely tied to inflation.
Wow.
Which doesn't give us very much comfort as real estate investors, guys looking for yield. But what's nice about the way the law is written is that if you have a new tenant, you can reset the rent. So if you have under market rent, but that guy, that family leaves, that new tenant now can be set. So say they're paying $600 and the really market is $900, you get this new person in, you don't have to worry about that increase, right? Because they're new. So if you follow the logic there, that's part of the reason student rentals are so appealing, because in Ontario, you have students, for maybe 2-3 years.
Right, you're getting a lot of turnovers where you can market adjust the rates. That makes sense.
Exactly, and it's not bad turnover. It's not like, it's just they're done and you've got a new one coming in.
Do you find? Yep. Go ahead. I was going to just ask you quick. Do you find that are the tenants motivated then to kind of toe their end of the line a little bit more for fear of being evicted for not taking care of the property, or?
You know what? It's almost it's the other way around. It's actually they're more savvy about being able to stay in units longer, because the eviction process on Ontario, it's so hard to evict somebody. You have to, for instance, non-payment of rent. You file what's called an N4. I'm sure every province and state has something different. Now, if they pay, as you know, if they pay on the 3rd, then they're back. Okay, we're good. So then the next month they go, and then they pay on the 3rd again. Now, most states and most provinces in Canada, what ends up happening is that if you do bring them to a tribunal or you do take them to court, usually a judge is favorable to the fact that if they're late but they pay in full, they'll usually let them go. So for us, the reason I bring this up is that when we got a suite back to us, even if the suite isn't in terrible condition, and actually Matthew Faircloth mentioned this too about good enough. In Canada, it's slightly different, because if you have a suite that's in less than good condition, but you do get it back, you really want to get it up as good as possible, because you could have that next tenant in there in theory for years. So you want to really get the highest possible rent. That being said, the market is also the neighborhood's going to determine that rent. You can't just build the Taj Mahal in that area.
Right.
Yeah.
All right, so we got the 11 units. It's operating. You got a clean bill of health on the roof. You got a new roof, and you've renovated the first unit, got the rents up. How big of a spread was there from where the rent was to where you were able to put it for the new unit?
So the rent we turned over. So we turned over one unit, but the unit the new unit that we turned over happened to be a current tenant upgrading into a 2-bedroom. And then they had their mother coming into this current bedroom. So we actually had a lift in 2 suites. So I believe we moved the rent from $950 to $1,250.
Oh, wow.
So it was a nice lift there. And then I can't remember the numbers on the smaller one, but I believe it was 150 or 200. So, a good heuristic that we do on, the apartment side or the commercial side is take whatever that lift is, divide that by your cap rate in your area, and you see what kind of value you've added to your building. So that after that, the only other thing on that 11 unit is that we're going to be putting in an application to add another unit because we happen to have a very large lower level laundry room. So John and I, we hired an architect that looked at the space, and he, from his kind of professional opinion, he said that you could put another suite down here, probably get a 600 to 800 square foot 1-bedroom, and gave us pretty much the protocol for the city, how to deal with that. And he said his rule of thumb on a unit that size in our area was approximately $70,000-$80,000.
That's awesome. I mean,
yeah.
To create a unit out of existing space and actually increase your rent, that's huge, especially with the system you talk about, how your rent control being so tight like that. I'm assuming that also puts a pressure on buyers to really analyze the seller's numbers and make your offer off of a actual, not some pro forma kind of thing. Is that true?
It's absolutely. It's just it's odd to us because every government policy will have those short-term implications for one group. What people often don't recognize is the long-term implications for groups that aren't visibly affected by the policy. And so you have some odd incentives that really bear out. And a good example of this, and there's a number of them, but it seems to me that if you have an apartment building, you're going to be very careful about renting to older aged people that will stay in one area and stay put for a number of years, which is a consequence of rent control in Ontario, in my opinion, and other states in America, is that you now have an incentive to discriminate towards people that might be in kind of the twilight of their years, and basically saying that this person can be here for 10, 15 years and won't have the mobility that a 20-year-old might have. Right. And I just think that's really unfortunate that if you don't allow the free market to really, let prices and the market decide kind of who you rent to. The other implication is, I don't know if you're too aware of the apartment world in Canada, but I think something like 90% or 95% of our apartments were built before 1970 in Canada as a country as a whole.
Wow.
We don't buy purpose builts. If you go to any major Canadian market, you'll find that when people say I rent, almost 9 times out of 10, they mean they're renting a condo from somebody that owns the condo. It's very rare. The concept of A-class apartments is not really a concept in Canada. There might be, you could probably name A and Bs on one hand in Canada.
Wow. That's interesting. So are the laws different for a condo a single rental if I'm renting my condo unit out to a tenant?
So this is the interesting thing, and this is what has shaken up our industry a little bit, kind of similar to the 1031, in the States. There's a lot of buzz about that, is that there was just proposed legislation that they would repeal a kind of loophole that condos had. So basically this was the loophole. If a property in Canada was built after 1991, they wouldn't be subjected to rent control. So I rent out a condo to a friend of mine or to anybody. If I wanted to raise the rent $500 because I felt that the market has just been going crazy, which it has been in Toronto, now what they've said as a result of this, they basically said that they're going to close that loophole. And there was, even if you Google, if anybody's interested, or you have Canadian listeners, if you Google 17 changes to Ontario real estate, you could probably 16 changes, probably put that into Google, you can find all these. But the reason this happened, and this is, your typical bureaucrat is looking at, okay, some guy probably had a condo and some landlord raised it $1,000 on him. That's really terrible. We should try to help this person. So instead of being more practical about it, they say, okay, let's get rid of that loophole. So now landlord X cannot raise 1,000. He can raise 1%. And what's interesting that I'm in the commercial world, I actually see what goes on the investment side, where we've had companies come in and say, you know what, we're finally at the place in Canada where we can start building purpose-built again. The valuations are at that spot. So you have our institutional guys prior to this legislation or this proposed legislation coming out saying we're going to start building purpose-built. And what do purpose-builts do? They create affordable rentals for people. Now that they have said, no, we're going to put this legislation through, I talked to a lot of those guys that were talking about their investment arms, these big pension funds building purpose-built. And now they're saying, our pro forma at 3-4% worked, but at 1%, it just doesn't work anymore. So we're going to stay on the sidelines and see if this legislation goes through.
And then I'm always amazed by, and I think there's I don't want to say there's no room for the talk of or trying to, I guess, smooth out some of the spikes in the marketplace. I know we're out here in Portland, Oregon, and they've essentially put the rent control. If you are raising rents over 9%, you have to now all of a sudden come up with some money to help those tenants that can't afford it or are going to have to move. You've got to pay them to move. And it's like, anywhere from $2,500 to $4,500, depending on how many bedrooms they're in, So, is it, I mean, obviously there's a housing shortage. That's really what the underlying theme is. And in your case too. And how do you fix a shortage? You create more, right? Yeah. But when you put these policies in place that curb the ability for the investor to make a return, they're going, I'll go over here. I'll go do this, or I'll just wait until things, settle down. And so I get the policy. I mean, what they're trying to do, but there's not the understanding of what the whole marketplace, how it works, and it's unfortunate because all it does is it kind of exacerbates the problem, and there you go. You still have people that are. Or a market that could certainly handle more units, but probably won't get the units that it needs in order to naturally help the supply. So it's interesting. We took a long time to come to the point where institutional companies started to look at the market and go, wow, we do think we can be compensated for our risk to now build apartments, because what we've had in our market for the most part is condo development, which is it's still risky, but it's less risky in the sense that these condo developers, they will eventually sell, that amount of supply that they have, they will get their cash back and go to the next project. Where these apartment guys, especially the large apartments, they have to stick with these things for a longer time, unless they're merchant builders and they sell them off after completion. Which I'm not sure in your market, the larger new developments, do you find that the owners will sell them, or are they long-term plays typically? Well, I think there's all sorts of, opportunities. I mean, depending on what's going on. I know there was a project downtown I'm familiar with. It was a big project that was, midway through construction that sold, and it was just the, I was kind of like, wow, I mean, like, nobody's even signed the first lease, and the numbers were that powerful. And the investor's goal is to get a return. So if they're in it for over a year and they can avoid the capital gains, because at least it's been going on for a year and they've accomplished what their goal was. I think right now there's enough sense that the market's kind of in the later innings of the game, as far as the increase. And so there's some sort of it depends on who you talk to, but I think everybody will say that when you start to see some concessions and some, the month over month or year over year rent increases are slowing down, that we've reached the top of the market. So if you can get a big return now as opposed to waiting, a 5-year hold or whatever you originally intended, I think that the developer might be, it depends. I mean, I think it all depends on what's the long-term goal of the buyer or the developer. If they are a buy and hold, they're probably going to just continue on. But if it's a syndication or something like that where you've got investors that are looking for a return, you're probably going to present it, and if they vote take it, you're going to be out. So but interesting. So I want to hear more about your newest purchase.
Sure.
I don't know if you have it under contract or if where you're in the process.
Right now we're trading paper on it right now. So it's actually, there's 2 properties that we're currently looking at. One is a 14 unit and the other one is an 8 unit. The appeal for the 14 unit is it just happens to be next door neighbors with the one that we purchased. And I know it's irrational, but for some reason maybe somewhat irrational, but you just have that comfort. You're like, this one has been going pretty well. It's almost the same vintage. Likely the phase 1, phase 2 environmental would, if they don't have it, we would be able to utilize the initial one because it's literally, 10-15 yards away from the other property. That one, there's a bid date coming up that we'll throw an offer in at. The other one is in the downtown area, and it's a little bit of a rougher area, but the appeal of this deal is that it's 8 units. I believe it's listed at $1.2 million, and we think that if we could strike a deal around the $1 million mark, we think that it's pretty interesting to us. And part of the reason that we like this deal so much is that the vendor in our last sign back, or last 2 sign back, who is out of the country, he's not a Canadian resident. He is going to put up a $200,000 VTB. So that's really appealing to us.
For the non-Canadian listeners, the VTB, isn't that tax? What's it?
Sorry, vendor take back. So there's going to be vendor financing on this. So the owner of this property will do a $200,000 mortgage.
Oh, okay. On a second. Gotcha.
Yeah, sorry.
Okay. Is there not a VT, or is there some sort of is there a tax that I thought in?
There might be a VAT tax.
VAT tax, maybe that's what I was thinking.
Yeah,
okay, so
value-added tax.
Trying to figure out how did that factor into an apartment complex there for a second.
Yeah, what the hell? Yeah,
exactly.
Yeah. So it was just a second mortgage where that really reduced us to the point where we have 85 to 15 loan to value. So if we're only putting 15% up and it's still cash flowing decently, that's really appealing to us. But we'll see how it goes. I mean, this is we're at the stage right now where we've gone back on price a few times, some of the other deposit structures, but your other listeners or people that have been on the podcast before have said, you really don't know anything about the building until you fly or drive down there and you see the thing in person and you walk it. So that's the stage we're at. The goal for John and I mean, we'd like to do 100 units in 5 years. It's for us, it's going to take some creativity, and just as I mentioned to you before, because cap rates are so low in our market, and I guess this would be as comparable to maybe in the States, a Denver or a California. I would assume those are comparable markets. Syndication is something that we would eventually want to do or need to do for these larger buildings. But as you know, with cap rates so suppressed, really you can't squeeze juice out of or blood out of a stone, and that's really the issue right now, because it's tough to syndicate deals when the yield is so low, because there's no gravy there to spread around.
Yeah, that goes right back to the the investors that are looking to create some supply. I mean, at 3% they were interested, now 1% or 1.5%, not so much. I get it. Well, it's interesting. The next door play sounds interesting from a standpoint of economies of scale for you guys, as far as I would think management or roofs or whatever it is, just some maintenance and all of that, to be able to have that proximity. That'd be good. In the 100 units, so when did you close on the first 11 units? When was that?
So the 11 units we closed in March of 2017 this year.
Okay. So
yeah, so we're right at the beginning here.
Got it. And then, so if you're able to, do you think you do one or both of these others if you could do both of them?
I think we would do, if we went with the one where we have vendor financing, a second mortgage, then it gives us enough cash that we could probably do a second deal. Maybe not the one next door, because it's pretty pricey in terms of what the list price is. But yeah, I think for us, in terms of conservation of capital, that deal where we can get vendor financing allows us to kind of have a half loaded gun to maybe wait another year and do something a little bigger. The challenge is, like, we talked a bit off the air about this, but for your listeners, that per unit costs in our area, specifically, let's just go from the downtown Toronto area. That's kind of say that's our Manhattan. We're looking at, in American dollars, you're looking at $200,000 a unit. If you go into the periphery, you're still looking at, on an American valuation with the USD, probably you're looking $80,000 to $100,000 a unit. So it's really hard for us to creep up without putting quite a bit of equity into these deals.
Do the rents track? I mean, 80 unit to 200,000. That's a pretty steep increase in value. Do the rents track
So if you go to, I guess if you say you have an 80,000 per unit type of property, you're going to get I would say on average, one bedrooms are going to go for 900, 8 to 900, two bedrooms, maybe 11 to 12, three bedrooms, 13, maybe 14, depending on the market. I'd say that'd be a rough southern Ontario, just outside of the periphery. The downtown cores, the Toronto area is a little different. We see, it wouldn't be useful to put a number out there, because you have everything from two bedrooms going for 3,500 to 4,000, depending on how what the hot spot is that you're in.
Right.
Yeah.
Well, it's interesting just to hear about your marketplace and just the I guess more of the policies that are in place that kind of really put a strangle on the return and the ability to increase the supply and all that. That's the cautionary tale, I guess, if you will, of policy and how to fix the problem there. But,
well, you guys have one I mentioned on the bigger pockets, and this is the one that kills us as investors in Canada, is the 1031 exchange. We don't have an equivalent tax strategy for deferral of capital gains. So basically, and I'm not sure if you want to define that. I don't know if you're.
Let's talk about that a little bit, because I'm kind of curious. I think just to kind of outline it for our listeners, I mean, a 1031 exchange essentially allows you up to 180 days to take the gain and put it into a new property that's at least as much or more, and you have to have as much debt as you came from into a newer property. You've got to identify within 45 days and complete the deal within 180. There's talk, and I don't know how familiar you are with all of our the tax talk, and I don't know what's going to happen. I mean, it's interesting, Trump being a real estate guy, and the Republicans' tax proposal has got a lot of interesting things. It would certainly change a lot of the appeal for real estate based on if they eliminate the 1031 exchange. But I'm kind of curious because the way it's been explained to me and what I understand is essentially what they would do is instead of the 1031, they would essentially allow you to expense the full purchase price in year one. And I say that, I mean, it's actually, I think if you take up, if you take all your income, you can expense up to 90% of your income from the purchase price. And then whatever's left over, you could then peg that to inflation so that if, you know, let's say you end up using 10% of the purchase price to offset your taxes, you'd still have 90% that could ride forward. Okay.
Yeah, I could move forward. Yeah.
Is there anything similar in Canada? I mean, how is it just flat out you sold something, you owe taxes?
Yeah. So this is good. I mean, it goes to the idea of one of the reasons why we have, I mean, on the purpose-built side, one of the reasons, you know, here's interesting stat is I think Toronto is number 2 or number 3 for the amount of cranes, construction cranes up in the world. I think there's a couple markets that are ahead of us, and it's not apartments that are being built; it's all these condos. But in terms of answering your question, there's no equivalent that I'm aware of. The only one that comes up every once in a while is people, you know, in forums. They'll, you know, even a couple days ago in the Bigger Pockets forum, I remember somebody saying something about this, but it's really not the same. In the event that you have something that's burned down, you can have a like in kind exchange for if it's like a replacement. But that's obviously not an investment strategy. But people will bring this section up in our code. But really, there's no
just trying to get you back to where you were, not improve.
Yeah. So there's no equivalent. So the result of that is that, and it's interesting because you brought up the developer selling midstream, is that what happens in the American markets is you have people at every stage of the game. You've got the buy-in holders, you've got the syndication guys, you've got the guys that are merchant builders that sell immediately. Whereas Canada, 9 times out of 10, if you're an investor, especially with apartments, you're a buy and holder. You're a buy and holder, or you're a guy that shouldn't be in our market and then probably just sold because he didn't realize it was the type of game that it is. Now, that's not the worst thing in the world to be a buy and holder. And actually, I think you've talked about this, that I would probably be a buy and holder regardless. But the unfortunate thing is that for us is that if we do sell our assets, our purchasing power immediately gets chopped by the capital gains that we have immediately after sale. Because in theory, if you're in the States, you could technically buy a property and never really keep deferring your taxes, keep 1031 to new properties, and then even in your old age, gift the property to your children, or you know what I mean, you could continue the deferral process. Whereas in Canada, the reality is that if you want to unload a property, you're going to have to pay taxes on it, and that's why you see so many of us basically playing the refinance strategy, where we refinance continually every 5 years, usually with these guys.
So is that essentially the way they get their money out, is the refi based on the appreciation or the rent growth? You can get your.
It's effectively a buy and hold strategy, which I mean is, you know, if government policy forced us to have one strategy, it's probably the one I would pick. I like the buy and hold.
Right.
That's probably the most appealing to me, and just continuing to add to your portfolio.
Right. No, it's actually, I think that's always been kind of my mindset. And, you know, I think that's where real wealth is built. I mean, I was reading Kiyosaki's the 4 quadrants, or the
4 quadrants.
Quadrant, I don't know what it is, something quadrant there, but it was, but I think that's really, I think most investors, that's it. You're trying to grow an asset that will produce long-term income. Not just because whether you're flipping or you're, you know, if you sell your property, you've got to pay taxes, and then what? Like you said, especially in your marketplace, how your purchasing power has been diminished just because you've lost all the your tax that you paid as far as your buying power. So that's interesting. Do you? I mean, from a U.S. based view of things, I mean, everybody's. You know, a lot of the froth in the market is the opportunity for everybody to make money. Yeah. Your marketplace is kind of buy and hold. Do values, are they kind of suppressed? I mean, because you've got the income, you know, the policy that keeps the rents from going up, which is essentially what drives the the valuations?
Yeah. I think it really, well, first we should make a distinction between the kind of the commercial and the residential side, right? We probably are, specifically in the Toronto and Vancouver markets, some of the hottest residential markets right now, definitely in the country. But we've seen an incredible amount of price appreciation, because you have to remember that the condo developments are just meeting an actual demand for space. People are starting to want to live closer and closer to the cities. We're seeing that on the commercial side, on the office side, and industrial, that we've seen rapid growth there as well, just as a result of immigration. Toronto, for instance, we do about 120,000 net immigration a year in our city. For a country, with only 32 million people, it's quite a bit coming to the city each year. So there's great fundamentals from that perspective, but I don't believe so. I think because the apartments are not similar in the sense that we don't today, new constructions of apartment is such a small fraction of our economy. It's almost non-existent. What we build for the most part is condo developments, and then obviously you have your office, industrial, and retail segments. So I think that we've just been, we've had a consistently steady market. The return is, for me as an investor, I'm constantly, after doing the Bigger Pockets podcast, I got a lot of emails from, just listeners asking questions. And what was interesting to me, how many Americans, said, if there's anything I can do to help, or I'm trying to get in real estate and I'm in the States. And that's starting to be more and more appealing to me, because it's almost like, Canada's one giant state and you're only allowed to buy in this state. And, if you're in the USA, you'd be like, oh, that's unfortunate. I can only buy in Florida, or I can only buy in New York. Whereas I'm really trying to start understanding what I can do to start purchasing investment properties in the States, and whether that means partnering with somebody that is a resident, or figuring out another way. Then I'm all for it. The challenge is usually, from our perspective, is lending. We typically need to get approved by an American lender, and as entrepreneurial as your lenders are, I've found it's a little challenging as a non-resident to really kind of bridge that gap.
Even with commercial property, when they're looking at the commercial property for the income?
So commercial property, it starts to become a little bit easier, and that's where I think that eventually, I think it seems like a logical next few steps in kind of my investing career is that it would make sense to eventually buy property in the States. It's just, the reality is it's the largest market, right? And if I'm an hour flight from most major, or a couple hour flight from most major American markets, it just seems logical to me that John and I would want to expand.
No. Well, it's encouraging for anybody in the States to hear that. I mean, we I think everybody thinks of their market as local. I mean, what you can see and drive by every day is kind of what you know at firsthand. And when you start to look in other markets, you're going, no way. And I would think that anybody that's used to being able to get a property in, a 10 cap or even an 8 cap, which is kind of like the benchmark, I think, where people try and underwrite to. I mean, whether or not the market supports that or not is a whole other thing. But and then to hear, that you guys are doing it up there with, what was the cap rate on the one you bought?
So the one we bought was a 4.5 cap.
Okay. I mean, that's pretty tight.
I just want to say that's properly underwritten. I know, you know our game. A lot of times you hear people, it's this cap, it's that cap. No, you sharpen your pencils, you look at it. It was a 4.5 cap.
Right. Well, and to your credit, I mean, you underwrote it properly, and you've also, it sounds like you've found a way to add a unit. And you've got a couple of units that have turned where you've got some additional income in there. So, I mean, it sounds like you're figuring it out. And I think more to the point is that you've identified the reason to do it is the long term. You're not looking to get in and get out, but it's the kind of long term buy and hold. And I think that what I've always thought, because I've bought properties at the high and I've bought them at the low. And obviously, when you buy them at the low, they cash flow a lot better right out of the chute. But as long as you're going to hold them for a longer amount of time, buying them high or buying them low isn't really, it's irrelevant. I mean, other than the fact that your cash flow is better when you're able to buy them at the low. But if your game plan is long term, I think you get in as best you can, or at least my experience. My experience is just get in kind of thing, and as time goes on, the asset appreciates, the rents go up. Eventually, you're going to have something of value, and whether or not you want to transition out or just hang on to it. I mean, the one thing that I always thought about just as a game plan is if I buy a property for X and over time the tenant pays the rent and that covers all the costs, and it never appreciates a dollar, right? Mm-hmm. At the end of the term, I will have that value of whatever that X was that I started with, that I put in basically a down payment.
Yeah, and guess what? In that scenario, you don't pay any taxes. I mean, if your property never appreciates, if you've never had any cash flow, but you've continued to pay down that mortgage, that money you get back is just cash.
Right.
It's just yeah.
Yeah, and you compare that to like investing in a 401k or some sort of an employer-sponsored retirement plan. In order for you to grow that, you've got to take from your paycheck and continue to put into that, and so it's you putting into that. It's essentially saving for that retirement and hoping that goes up in value. Obviously the history shows that it does go up, but still you're having to put into that each month, whereas the way I look at it is the tenant's putting in each month into my retirement thing. Yeah.
Well, you know what? I mentioned Tom Wheelwright, and it seems like it's an odd point to continue to make, but that piece of depreciation there, the way he always says it is, what other asset do you have that the tax laws assume that it will go down in value, right, but in reality it continues to go up? So you're given this gift, Canada or the USA, you're given this gift of an expense to really take your tax burden down to zero or close to zero, but be able to continue with, because it's a non-cash expense, be able to continue to make money. Right. And that's just a piece that I love. And just for context for your listeners too, when I say a 4.5 cap, I don't know what you guys are lending right now from the Fed, but our interest rates right now on that type of deal would have been in the mid twos. So we'd be getting debt at like 2.4%, 2.5%. Wow. So there is, because I hear a lot of guys I speak to in the States, and they go, well, how do you even make that work with debt at 4 or 5%? It's like, well, in agency debt or debt that's insured in Canada right now, even for 5-year commercial deals, you're able to get probably now it's creeped up a little, but it's around 2.6%. Well,
that's pretty competitive. I mean, that's so. Well, at least your borrowing costs are low, and sounds like if your goal is long term, it's going to work, right?
Yeah. Well, you need some spread, or this whole real estate thing starts not working for you.
Right. Yeah. I'm looking over kind of my list of stuff, and I really, to me, I love your story about starting off in college, and making it work, and then kind of exposing us to a little bit about the Canadian way things work with the policies and the taxes. I mean, that's people for all the complaint and the talk about taxes. When you compare it, it's a pretty good system we have here. And now that you're a broker and you're buying and investing yourself, it's a pretty cool story. Is there anything we didn't talk about that I'd kind of laid it out? I'm thinking we've covered a lot of ground here, and I love the story. I want to hear your next deal here. I want to hear how it comes out on the 14 or the 8. See what you guys end up doing.
Yeah, I guess we'll see how those go. No, you know what? I think that's pretty much it. Well, for us, for John and I, what we're trying to do, and I think what's interesting, you don't hear people talk about it too much because maybe it's on the mediums themselves, but the podcasts, the investment forums, the monthly meetups. I hear now after being on a few of these that the guys always ask me, where do I go to start? And if you're out there and you're thinking about getting into real estate, there's no excuse not to today. It's not like it was 10, 15 years ago. When YouTube wasn't around, or you didn't have these, a forum like the Bigger Pockets forum. Get out there, figure out in your market. I'm sure there's an investors meeting that's probably talked about on one of these various forums, and just try to get involved. And the only other thing I would say to people that are starting out specifically is that if you really want to understand a market, and you say you're doing your first deal in a market, don't be afraid to reach out to property managers in those markets. It's not always a perfect indication, but it's a really good asset to be able to test or feel out where a market's at, or maybe a property that you're buying, because those guys, if it's their day job and they do it well, they're indispensable to you. And maybe you do end up managing it yourself, or you end up utilizing property manager. I feel like that's a question I get a lot. People ask about my first deal. I don't know if this is a good area. I don't know if it's all these things are these old buildings. All those type of questions, I feel that you really can get the answers to those. And more importantly, property managers typically want to give you those answers because they look at you as a potential client down the road.
No, amen to that. I think that's an excellent place to start, and I couldn't encourage people to do that enough. I mean, starting with a property manager that knows the ins and outs and can make you aware of to where you're accounting for it, like we were talking about, just the capital expenditures and what should be or what is or what isn't in place can really save you a lot of pain down the road. That's excellent advice. So, and like you said, all the online resources. I mean, Bigger Pockets is a great resource, and all the different podcasts and opportunities to connect and get to know people and learn from what they've already done or what they're doing or different markets and that. I think it's a great idea. Jesse, I want to thank you a ton for taking the time to do this, and appreciate you letting us know how you've done it, what you're doing. And before we let you go, what's the best way for listeners to connect with you if they'd like to?
Yeah, I tell most listeners, if you have any questions, I try to answer anybody who will send an email in. Just fire me an email. It's Jesse, JESSE FRAGALE @gmail.com, and just put in the title, just real estate podcast, and hopefully I get it and can give you a half decent answer on something.
Cool. Well, I'll put all that in the links in the show notes there if you are driving and weren't able to get that down, so be sure to look that up. Jesse, I want to say thanks again, and look forward to doing this again soon. For our listeners, if you like the show, be sure to share it with somebody and be sure to share Jesse's story. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.